are the basic concepts of accounts. We come to the conventions of account. Convention, they are tradition or norms which are preserved to prevent and protect the preparation and presentation of accounts, accounting information. In convention, we have 4 conventions. 1, full disclosure convention. Now, what do you mean by full disclosure convention? Full disclosure convention states that all business transactions must be clearly disclosed. Number 2, consistent convention. Under this convention, business transactions must be recorded in a consistent manner. Number 3, conservation convention. Under this convention, all business transactions must be preserved. The recording of business transactions must preserve particular nature. For example, cost concept. Under cost concept, we are preserving the original cost of recording business transaction. Finally, materialistic concept. Under this concept, all business transactions must be record all items of material nature. Any item of immaterial nature must not be recorded. So these are the critical principles of accounts. Have them, use them. The best way to do it, remember them. Now we move to another very important area, which is cycle of account. Now in cycle of account, our basic understanding is just to understand that they are processes which are followed while recording business transactions. The process starts with original entry and it ends with the preparation and presentation of financial statement. The accounts which are involved in the cycle of account is 1, the journal entry, 2, the ledger, 3, the trial balance, and finally, financial statement. Understanding cycle of account. To understand cycle of account, we must understand the following. 1, these are the pillars of accounts. Accounting equation. 2, types of account. 3, rules of debit and credit. This determines the pillar of account. After getting the foundation, we must establish the pillars. So there are only 3 pillars of accounts: accounting equation, types of account, and rules of debit and credit. Accounting equation. Now in accounting equation, we state that the formula that shows the relationship between the owner's equity and the assets of the business. In other words, we are saying the equation shows that total asset must be equals to total liabilities. Formula: assets must be equals to equities. In other words, assets equals to capital plus liabilities. A equals to C plus L. Further, we can say C equals to A minus L. Further, we can say liabilities must be equals to assets minus capital. Now, types of account. Another critical pillar in account. They are accounts which are used to record all assets, liabilities, expenses, and income of a business over a given period of time. They include 1, personal account, 2, impersonal account. Now, what do you mean by personal account? They are type of account which records only accounts which bears individual names. For example, they include capital account, joint company, name accounts, etc. The rule: debit, the giver; credit, the receiver. Apply the rule as you do the recording. Number 2 is impersonal account. What do you mean by impersonal account? They are type of account which record all assets, expenses, and income in a business. It is further classified into 2. 1. Real account. 2. Nominal account. What do you mean by real account? Real account, they are types of account which records only all assets in a business undertaking over a given period of time. They include land, cash, purchase, etc. Rule. What are the rules? The rule is that you debit what comes in, you credit what goes out. We come to nominal account, the second type of impersonal account. In nominal account, the type of account which records only all expenses and income of a business over a given period of time. They include salaries, rent, discount, receipt, and any other expenses and income. The rule governing this account, you debit all expenses, you credit all income. Now, rule of debit and credit. Under this rule, we have the rule was put forward by Lucas Passaglio which states that whatever you debit, you must credit. Under this rule, we understand the following. 1. What is it? 2. Where is it? And then 3. Which account is to be debited and credited? They include 1. Revenue. Increase in revenue, we credit. Decrease in revenue, we debit. 2. Expenses. Increase in expenses, you debit. Decrease in expenses, you credit. 3. Assets. When assets increase, you debit. When assets decrease, you credit. Finally, liabilities. When liabilities increases, you credit. And when they decrease, you credit. Using the arrows gives you the direction of debiting and crediting. Once we